Hey everybody, JT here with Treasure Valley Financial Planning. It is February 23rd, 2022. I hope this finds you well. I wanted to jump in today and provide some commentary and some perspective around the current markets and world events. And what you're seeing before me today is a lot of numbers, or actually, I should say, a lot of information with charts and graphs and some numbers. But this is really important to have perspective when we're going through a time such as this. It's always easy to think what's going on right now is the worst thing the world has ever faced. And we're so quick to forget um, how bad things have been in the past. So if you take a look here on the, I'm going to try and scroll in here a little bit. All right, I'm back here. What we're looking at here is a timeline from 1926 all the way to the end of 2021. And I want to focus on these dots with these different world events. Right now, we're obviously going through an interesting time with Russia and Ukraine, and there's some other things underlying as well, causing concern with inflation and interest rate rising. And it feels right now like things are uncertain and things are pretty volatile. Well, and they are. But it's good to remind ourselves what we have gone through in the past. Much more intense was 2 years ago, around this time when COVID broke and the stock market fell faster and more intensely than ever before. We all remember that. It was in March, and you can see that drop right here in 2020. And since then, we've had some nice recovery there. Looking back, the US-China trade war, the Brexit vote, conflict in Ukraine, the Affordable Care Act was enacted. Back 2008, 2009, big problems there with the subprime crisis, Wall Street Reform Act, the bailout of AIG, GM and Chrysler bankruptcies, lots of bailouts and buyouts. Going back a few more years, we had 9/11, which was very harmful to the market for a time as well. And then going back even further, you can just look through this and see how many world events we have gone through. Further down this chart is in this black bold line right above the presidents here. We have the different world wars, the Iraq War, the Vietnam War, the Korean War, World War II, and World War I. We can also see the different presidents changing hands, Republicans and Democrats, from Trump to Obama to Bush to Clinton to Bush to Reagan, Carter, Ford, so forth, all the way back. You can also see on this line down here, taxes being cut and taxes being raised. You can also see the federal deficit going up over time. And as we scale back, what we're looking at here on the far left, going back to 1926, is if we invested $1 into these different markets and we didn't touch it, how much we would have ended up with in 2021. Now, I want to focus at first on this dark blue line. This is the most volatile line. You can see in 1926 and through the 30s had tremendous problems. The market was not regulated back during those times, and during the Great Depression, it was very speculative. But since, the 40s or so, you can see how that dark blue line has been volatile in the short run, but it has grown tremendously in the long run. That represents U.S. small cap stocks, smaller companies. Those have averaged 12% return from 1926 to 2021. So by investing $1 and holding it for all that time, we'd end up with 56 grand. Now, a more conservative approach would be to own US large stocks. These are bigger proven companies that have less chance of default. You can see that those have averaged 10.5%. And you can also see that they have been volatile in the shorter run, but have been less volatile than the small cap. And then coming all the way down to these two orange sections here, you've got two kinds of government bonds. You can see how they don't fluctuate as much. They still appreciate over time, and they've averaged 5 and 5.5%, but they're more conservative. And then you can see inflation and treasury bills. I want to focus now on this yellow line. This is a balanced portfolio, 60% stock, which is 10% of the large cap, 50% of the small cap. Reverse that, 10% small, 50% large, and then it's got 30 bonds and 10 in cash. You can see what that does to have a balanced portfolio over time. It has average 9% return in the long run, and it smoothed out the volatility in the short run. So with good money management and a blended portfolio, we can smooth out the ride a little bit. But just focus for a moment where we are right now. If I zoom in on this, and you can't see this because we're in 2022, but the market dropped much more in 2020 right here, and then popped up pretty good, was flat, and now it's down again. But this is just contraction in the market. In order for the market to spring forward, we have to have contraction. It's like a rubber band. It's going to spring back to propel itself forward. The market has performed well in the long run, despite Republicans or Democrats in office, despite world wars, major world events. We've been hit with all kinds of things. Why is this? It's because we're investing in innovative people that run companies that figure out how to navigate all this stuff. Think about Disney for a minute. When COVID hit 2 years ago, it was common to think that Disney's going to have a hard time. No one's going to Disneyland and no one's going to the movie theater. And what did they do? They innovated by coming up with Disney Plus, so people now pay a subscription to get the movies downloaded or streamed right onto their devices anywhere they are. And now Disney has weathered the storm, and now they're opening their parks. And they've actually been open for a while, but they're slowly coming back to full service on those parks. So we are entrepreneurial people in our country. We figure out a way to innovate, to create a profit for our shareholders. And the other point I want to make is we are opportunistic people. If you think about your favorite thing to buy, let's say it's a nice expensive item that never goes on sale, and all of a sudden that item you love to buy goes on sale by 50%, you're likely going to go buy more of it. And it's no different with the stock market. When the market's getting beat up like it has in January and February a little bit as well, not as much in January, people and big institutions are waiting for these opportunities to put a lot of money back into the market. And when they do that, it's going to propel the market forward. We are bullish on the market. I want to make that clear for 2022. Do we think it's going to be a rocky ride? Absolutely. The next few months going to be volatile? Absolutely. Do we know what's going to happen with the Russia-Ukraine? No, we don't. But we still like the fundamentals of our economy with jobs, and which is much more important than the market just reacting. So pullbacks are normal. They are necessary, in fact, to spring forward. And we'll make it through this just like we do everything else. We have made changes to the portfolios, as we mentioned before. For most of the portfolios, we rotated to 30% cash, clear back in January 2020. I think the 24th of January. We've remained in that posture. I thought we'd only be there a few weeks. Here we are a month later. We're still there and likely will remain there for a little while. So we are pumping the brakes. And also, if there's extra money on the sideline, this isn't a bad opportunity to buy in. So we are watching things very, very closely. We're managing the accounts accordingly. Doesn't mean the accounts won't have some volatility. They still will. But the most important thing from all of this is always bring it back to your personal financial plan. Are you still on track? Can you still retire or remain retired? And if I was concerned about that for you, I will have reached out by now and we will have talked about it. So just because the markets are volatile doesn't mean that our overall plan is off track. In fact, we run our plans knowing that the market is going to be up and down at times. So what do? We control what we can control. Watch less news if possible. I know we want to be informed, but just remember they're there to sell headlines and boring news doesn't sell. Have faith, stick to the plan, and communicate with me and your advisor team more often. We're going to be meeting with everybody, if we haven't already, over the next month or so, say 6 weeks, for our annual preview meeting. And that'll be a great chance for us to touch base and work through any personal concerns you have and questions and make any necessary adjustments. But we have your back. We're in here with you, and we are watching things closely. Please reach out to me if you need to prior to us reaching out to you in the next week or so to schedule your meeting, and we'd love to visit. This is how investors are rewarded, by having courage. We did it 2 years ago during COVID. My message was investors are rewarded by having courage. Here's another opportunity where having faith in Americanism and faith in the market is tremendously helpful. So hang in there, use us where you can, and shoot us any personal questions or concerns. We're happy to address them. Thank you. Hopefully this was helpful. Have an awesome day.